In today's video, we're going to talk about EVGO, trading under the ticker symbol EVGO. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. So most of my videos are recorded and scheduled the day before and uploaded for the next day. For 5 days out of 7, it's a trading day, so of course by the time the video goes live on my channel, the price would have already evolved from there. If there are significant and very volatile movements during the trading day, obviously they will not appear in the video on that day. But usually, to the extent possible, my analysis will be based on the medium term and not really focused on the intraday movements. The reason why it shouldn't matter that much either way is because most people investing in stocks invest for some kind of reason that takes time to get developed, and that their positions are usually kept for at least a few weeks. With that being said, if there are significant stock price movements that happen afterwards, either they will not affect the overall picture, or if they're significant enough, they will be mentioned in the next video about the stock with reevaluations of the circumstances as needed. EVGO is a startup operating in the energy storage and charging segment, with its EVGO network and charging stations for the electric vehicles. It is a company with strong fundamentals and good earning results that encourage the market participants to increase their exposure to the company, and it is a peripheral of the electric vehicle sector that is very popular within the market at the moment, regardless of which manufacturer the market is eventually going to favor over the others. They all need charging stations, and this is where companies like EVGO will rise and shine because they can benefit from the increase of overall demand for electric vehicles over the next decades, which is set to increase its volume significantly over time. As the delivery and storage systems improve in their efficiencies over time, there is a fair chance that the stock will become more valuable. The market cap for EVGO is currently at $4.3 billion, and the enterprise value is at $167.4 million. The market cap is the price tag financial market is willing to evaluate EVGO stock at, with considerations to its future potentials as well as the short-term fundamentals. The enterprise value of the company is the net result of the company's assets once all the debts are paid back. Usually, the market cap is higher than the enterprise value, but sometimes there may be exceptions because the company may be highly leveraged or be under a lot of pressures from the market, such as a large short position. The quick ratio for EVGO is at 42.77. The current ratio is at 42.77 as well, and the debt over equity is almost zero. In other words, the company has a lot of liquidity and doesn't have a lot of debt. The average trading volume for EVGO has been 30.8 million shares, and the daily volumes in the recent days have been 21 million shares, 22.8 million shares, and 62.6 million shares. The 1-year beta of EVGO is 1.86. Its 52-week high is $24.34, and its 52-week low is $7.17. Now, let's also talk about the options market for EVGO. In terms of volume and open interest, the options market seems to favor the call side, but with significant demand on the put options as well. Generally speaking, put options mean that the market expects a pullback, and the calls options mean that the market expects the prices to move up. The key strike prices where there seems to be the most interest are $17.50, $19, and $20. The market is currently viewing EVGO with a great premium over what its assets are worth for, mostly because it really likes how much profit it's already making. And we're still at an early stage in the process of electrification. Over the past few trading sessions, the price of EVGO went up significantly, which is logical, but also means that maybe a better entry point should be available over the next couple of days. It's also worth mentioning that there are alternative companies that are worth buying, such as ChargePoint and Volta, to form a basket of portfolio subset regarding the charging stocks in particular. So I would recommend to commit between 1 to 3% of your portfolio in EVGO or up to 5% for a basket of charging stocks as a whole. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.